Welcome back to the Small Multifamily Due Diligence Checklist. Chapter 8. Obtain all financial information. In the pre-offer due diligence period, you should have already conducted a basic financial analysis, which is a crucial step in the process of buying a rental property. You will now need to redo the financial analysis against the seller's actual financial statements to determine if your financial analysis is accurate. You should be asking for the following items: trailing 12-month financials, last 3 years of rent rolls, last 3 years of income statements, expense reports, profit and loss statements, last 3 years of capital expenditure costs, last 3 years of repair expenses or repair log entries, worst year financials since seller owned the property, pro forma adjusted with up-to-date property taxes. Investors should make sure numbers being presented are not all ending in rounded numbers. You need to be looking at real numbers, not estimates or rounded numbers. Investors will want to go through the rent rolls to ensure occupancy levels have been steady over the past several years. If the property had a higher level of vacancies in the past but is suddenly at a higher level just recently, the seller could be trying to get people in to boost their numbers because they know it will bolster better-looking numbers in the pro forma and increase a potential sales price. The rent rolls will also indicate the security deposit amounts that would need to be forwarded to you, as well as when the leases will expire. Investors should watch for any long-term leases that might last for more than 2 years, as well as when the leases end. It would be preferable for a majority of leases to not all end at the same time. This would increase risk from a leasing standpoint. You'd rather not have to fill half of your units at once, especially if that time of the year might be off-season in your local market. Investors need to recalculate the 5 calculations for income analysis. They should also throw another 4 calculations into the income analysis to ensure they are covering all their bases and making sure financials are to their liking. 1. Calculate the debt coverage ratio, DCR. The debt coverage ratio measures the investment property's ability to cover the debt service. DCR equals annual NOI, annual debt service. For example, a property has an annual NOI of $115,000 and an annual debt service of $95,000. $115,000 divided by $95,000 equals 1.21. Investors would like to see a number above 1 here, the higher the better. Most of the time it would be recommended to avoid deals that do not meet at least a 1.2 DCR in case of a worst-case scenario. Maybe occupancy rates decrease or expenses increase. This would reduce the NOI and thus reduce the DCR. A DCR of at least 1.2 provides a bit of a buffer for the investor to run into some potential problems and still be able to service the debt via income of the property rather than have to dive into savings or accrue other lines of credit or loans to pay the debt service. 2. Calculate the exit cap rate, ECR. The ECR is the market cap rate after your planned holding period. Essentially, this calculation's purpose is to estimate the future sale value upon your exit period, which could mean refinancing or an outright sale of the property. The market cap rate is the cap rate average of the immediate local market the investment property is located in. This is found by taking an average of several buildings that have recently sold in the area. The market cap rate is not the cap rate of the specific deal or this specific piece of investment property. ECR equals annual NOI, market cap rate. So let's say, for example, you plan to purchase an investment property for $1,200,000 and the market cap rate at that time is 6%, and you plan to hold the property for a period of 7 years before selling it. You estimate at that time the NOI would be $100,000 and a market cap rate of 6%. Therefore, ECR equals $100,000 per 0.06. ECR equals $1,666,666. Now let's say you purchase the property and you are in year 7 and your NOI projection of $100,000 is accurate. The property has a NOI of $100,000, however your projection on the market cap rate was wrong, and instead of it being 6%, the market cap rate is actually 7%. Therefore, ECR equals $100,000 per 0.07. ECR equals $1,428,571. You see, just off a 1% difference in the market cap rate, you could have a difference of $238,095 in the future resale price of the property after 7 years. Ultimately, being able to project future market cap rates effectively again depends on the investor's knowledge of the current market conditions as well as headwinds or tailwinds that the local market could be facing in the near future. If things go downhill in the area and market cap rates jump up, appreciation in the property will not be as great as if the area improves and market cap rates fall. Then the future resale price would be higher and therefore make the deal more profitable and more likely to experience accelerated appreciation. This oftentimes is why investors say it's better to purchase the uglier house in a nicer neighborhood, or for investing purposes, possibly purchase Class B structures located in Class A neighborhoods, or possibly even Class C structures in Class B neighborhoods. 3. Calculate the break-even occupancy point, BOP. The break-even occupancy point is the actual physical occupancy percentage that is required to break even on the investment property. In other words, how full the building has to be in order to break even or meet all debt service and expense requirements. Below the break-even point, investors would find themselves in a negative cash flow situation. This calculation also serves to indicate how much risk might be in a deal. Obviously, keeping a building completely full with zero occupancy is not an easy task, and investors should never be making calculations with a 0% vacancy rate in mind. The higher the BOP, the higher the level of risk in the deal, because there is less room for error when it comes to how full the building must be to meet its break-even point. BOP equals annual operating expenses plus annual debt service, gross potential income. So, let's say for instance, your potential deal has annual operating expenses of $100,000 and annual debt service of $95,000. The gross potential income is $270,000. Therefore, BOP equals $100,000 plus $95,000 per $240,000. BOP equals 81.25%. Therefore, the building must be at least 82% full just to meet its break-even point. Any occupancy level higher than 82% should indicate the building is producing cash flow, and any level below 82% would indicate negative cash flow. So how risky is this deal? Well, it again probably depends on the location and immediate area the building is located in. Keeping 8 of every 10 apartments full in a good area could be easy, while keeping 8 of 10 full in a not-so-great area could be incredibly difficult. So again, it pays to know your local market. Another calculation investors would want to make would be 4. The price per unit, which is simply the sales price divided by the number of units. This will give a quick cost per door of the investment property. These calculations may seem daunting, but it's one of the most important components of your due diligence. Thanks for watching. Be sure to like the video and check out the small multifamily due diligence checklist Chapter 9 checking zoning rules.lakerrealestate.com 763-645-4617.